Hello everyone, good morning. Thank you very much for joining us today. It's horrible weather this morning, horrible markets, and as you said, maybe some of you are hungover as well. So thanks again for taking the time to be with us today. So yes, our panel title is Quant Strategies, Risk Controls and Institutional Allocation in Digital Assets. It's a very broad topic, lots of different ways that this discussion could go. So we'll try and keep it quite focused today. It's a basic agenda. I'm going to be asking the panel to essentially really start off by setting the context. What is it we're talking about here? Then moving on to talk about the implications of various points within the space and summing up with our thoughts of how the space will evolve over the next 12 to 24 months. A very quick introduction from me. So I'm Daniel Blackmore, Chief Commercial Officer at GLASSNODE. GLASSNODE is a digital asset analytics, data and research company. I'm also a board advisor to our sister company called Swissblock. Swissblock is a traditional and digital asset proprietary trading firm running systematic mandates. More importantly, I would like to introduce my fellow panelists. Firstly, Ryan, I know you've been introduced briefly before, but I'll give a bit more detail on your background. So Ryan is Head of Digital Assets and Strategic Investments at Barclays, leading the bank's digital asset strategy, governance and tokenization initiatives, as well as the strategic equity investments across Europe and Asia. He previously held roles at Nevsky Capital and Deutsche Bank. I'm also joined by Anna Dinescu. Anna is a partner at Hilbert Capital, an institutional digital asset manager listed on Nasdaq Nordic. She co-founded Liberty Road Capital, later acquired by Hilbert, and brings 15 years experience across risk management, capital strategy, and institutional adoption, including roles at EY and Oracle. I'm also joined here by Jennifer Shaughnessy. Jennifer is Chief Revenue Officer at coinroutes, an institutional trading platform. She focuses on digital asset market structure, institutional sales and partnerships, and previously founded and ran an asset manager, giving her hands-on experience in portfolio construction and risk management. And last but not least, I'm joined here by Bohumil Vosalik. Bob is founder and CIO of 319 Capital. He's a professional investor for 15 years and active in crypto since 2017. He allocates to quant and systematic digital asset hedge funds across HFT, DeFi, market neutral, and long-short strategies. So, to start off, what do we actually mean by institutional grade or institutional ready products, infrastructure, etc. in the space? It's not binary, it's a spectrum. We've gone from interesting characters in the beginning of crypto, perhaps trading out of their parents' basements, to titans of industry, Larry Fink, for example, becoming true proponents of the space. But where actually are we in this maturation overall? What does institutional grade mean? I'll start with you, Anna, at Hilbert. What are the important risk controls with regards to, say, strategy, execution, data, governance, etc.?
So thank you for that intro, Daniel. I can see from your picture that you've done this before. Pro. Well, institutional grade. We praise ourselves at Hilbert that we are having the whole institutional grade kind of pedigree. I think it's important in general, especially right now in these times, for the crypto markets to try to tick all those boxes for institutions. And that encompasses a very wide range of things, from compliance, governance, risk management, and many others. Obviously, depends on what type of investor. It's very much related to your investor preferences, where those boxes are ticked. But generally speaking, it gives a lot of credibility if you're a listed company, if you have audited returns, if you have a solid track record, if you can demonstrate that your systems work accordingly and they are ready and updated frequently, and more important, obviously, you have a very solid risk management. Those things probably are what we called a very solid institutional grade background.
Ryan, I mentioned titans of industry before. Barclays, absolute monster in the space, obviously. What's important from your perspective?
So, as people will have realized, I guess a lot of banks have been quite hesitant to get into the digital asset space primarily through the crypto route, and that was for a number of reasons, right? One was the lack of regulatory clarity. There was the issue around capital treatment of that. And as we said, when it, in its inception and its foundation, when it blew through the retail space, it made institutions reluctant to embrace that in the first instance. As you say, that now is starting to evolve significantly, right? We have here in the UK, the FCA putting out consultations to bring in rules over the course of next year. The Bank of England is paying attention on the more systemic side. We obviously have the US starting to put in those frameworks. So that is now starting to change. I think the capital rules that underpin that will start to shift. And so then the onus becomes more on financial institutions as to how they start to think about it. And you've seen it with a couple of the big US banks who have gone from very skeptical to starting to embrace that and say, well, okay, if this is a market that is indeed here to stay, it is going to be imperative that banks start to work out where they want to play. From our perspective, the infrastructure point that was made is important. It's not quite so simple as just saying, banks have to rethink, I guess, how they engage with this new market, and to a certain extent, they want to see scaled infrastructure that is often backed by firms and institutions that they know. They want to make sure that has some resemblance of the existing world. So, the idea that you have a single institution that provides front to back across the whole custody trading solution, that is not a construct which banks are particularly familiar with, and so they'll look for best-in-class capabilities to emerge across every layer, right, from custody to portfolio management, execution systems, to reconciliation to the back office. But I think obviously the key thing for banks won't just be leaping into the crypto side, but it'll be this whole shift that we're starting to see on the TradFi side, right, which is all of the FMIs starting to think about tokenization of existing securities. That starts to open up a key gate for institutions to say, okay, well, if we can see that coming down the pipes, crypto doesn't just sit in its own little silo. Now we have to think about the whole institutional adoption. And at the same time, we're starting to see some of our clients who will likely only get into the space if they're facing someone like their traditional banks who ultimately they know and trust, who deliver a lot of these services. So I think it's kind of quite a critical inflection point for the industry as banks start to formulate their plans around this. And bearing in mind that is quite, on the one hand, banks have been dabbling with this space for a decade plus, but equally that point of view of starting to engage with crypto more seriously is a new development, and I think you will see quite a lot of activity from different institutions as they start to formulate plans.
The infrastructure point's particularly interesting to me with regards to execution. I know it's been very clunky for a very long time. How's execution changed over the years, in your opinion, Jennifer?
Execution has changed in the sense of I would say it's become a lot more sophisticated. You can't just have a simple smart order router. We have a really good one. We've patented it, but I think you also have to layer it on top of other algorithms. So you can have like your smart order router layered on top of a TWAP, a spread order that you also use. And then I think also you just need to be able to execute across multiple exchanges and even sometimes to execute across multiple asset classes, which is something that we facilitate for our traders.
Bob,
maybe if I can jump in real quick on this first question, actually. We all speak about kind of the infrastructure, the custody, etc. Very few or very little we speak about the teams themselves, right? In what is an institutional quality team? And I mean, crypto and digital assets are sort of very often routed in in Call of Duty, in poker, in areas like that that actually are not sort of seen as the traditional space, right? You don't see necessarily teams that come from Wall Street. You don't see teams that would be, you know, trading at other large firms. And I think that is definitely one difference that some allocators might have a issue or might need to get their head around when it comes to spending time and allocate it to the space. Who are these people that we're interacting with?
One thing I've always found quite interesting in the space, trading, capital markets generally, is people bandy around terms like quant strategies. I'll ask you, Bob, what does that mean? What are some good examples of different trading strategies that are actually effective in the space?
Well, effective, yeah, that's a good question. So, I mean, I see quite a few actually hedge funds in the space as well, so we'll be obviously mentioning the strategies. I would say there's kind of three key families. So you have directional strategies, non-directional, and as part of that, sort of anything that relates to DeFi or yield, where you have some visibility on what you can achieve. On the directional side, no surprise there, very sort of C-tail-like strategies. You're betting either on momentum, you're betting on some mean reversion, but in general, you're using statistical tools to come up with some sort of signal. On the non-directional side, there's a bit more variety from that perspective, and I would say that's what crypto has been known for, initially, if you want, when it comes to high-frequency trading, when it comes to cross-exchange arbitrage, the basis trades, so spot futures, or perps, obviously, and similar strategies where, at least for the first few years, you didn't have to take the directional risk and still make very interesting returns, especially in basis trade was double digits. Now that's coming down quite a lot. Crypto overall is or digital asset space is very innovative. There's new products, new ways how to trade, or new arbitrage strategies that are coming to place quite a lot. And that especially you see that on the DeFi side. So there's different ways how teams basically allocate capital to bootstrap liquidity in different protocols. Something you don't see in TradFi, right? You don't bootstrap liquidity for exchanges, etc. So that's definitely unique to digital assets. But then, as was mentioned on the previous panel, you can push that a little bit more. What I mean with that, you can basically pull in real-world assets that you can issue tokens against. You can use those tokens, get leverage on Aave, Morpho, and other basically platforms, and play that interest rate arbitrage. You can do loopings on top of that, again, create more leverage, and similar strategies that, again, generate return. I would say very often that comes with different volatility of these returns. So on the high-frequency trading side, you kind of know roughly where you will end up, because it's getting more competitive, but you're not taking the downward risk. On the long short, on the market neutral side, that's more volatile. So market neutral, you could say plus or minus 3%. On the long short could be plus or minus 10% or 15% in a month, but much more volatile if your models are not working correctly. On the DeFi side, 2024, really great year. 2025, a lot of kind of on the larger side turned to 10 to 15%, and I think that's where 2026 will end up as well.
Anna, building off of some of the comments that Bob made, I mean, a lot of the strategies sound very sophisticated, and it's very easy to throw a lot of jargon out there. Not that you were, but certainly there's it's hard to perhaps understand for a lot of the different digital assets strategies that are out there. What are the actual risk exposures that allocators are perceiving? What is it that they care about? How are they ingesting these risks or understanding them? What's important to them?
Well, depending on, as I said earlier, depending on what type of investor you're looking at, they have different type of risk metrics or expectations, let's put it in general. And I would say there could be two different types here, maybe retail, ultra high net worth, and individuals who look more into the preservation of the capital, not so much into the risk metrics. They're not so sophisticated, and they are much more prone to what Bob just said earlier, to the team, to the trustworthy, to how confident they are that that company is safe and knows the employees know what they're doing, and they're really specialists. And then it's obviously the institutional side, who they go through much more accurate due diligence. And when we talk about due diligence, this is obviously something that in the crypto space is much more in-depth. I think it takes more time. I think where institutional investors are more cautious about it, and they need to kind of see those things ticked. And even in the institutional side, if they come from a TradFi background, it's something that it's a gap in their analysis. In institutional and the TradFi, usually they go and they look at things like VAR. If you're looking at value at risk as an indicator in the crypto space, that is not really accurate. You have to look at other risk indicators. And this is where, you know, the innovative companies come to the table. You know, what are you looking at? What are your risk indicators? How come you bring to the table something that we haven't seen before? And how you're actually measuring your risk? And there are a couple of things, like we can look at EVAR, you can look at other risk metrics. Now, we have seen this AI coming lately. I have to bring it up, sorry. I mean, maybe it's a little bit early, and please feel free here to jump in. You have to be ahead of the curve. You have to use it. We are trying to incorporate that and into our trading, signaling, into everything that we do. We have right now running 4 agents in parallel that are trying to innovate on the base of what our trade signalings have been in the past. So all those things, they create that kind of, you know, credibility, or the fact that you are actually proactive in what you're saying that you're doing, and you're trying to provide the best results for your clients. And I think that's very important for an investor, and especially for an institutional investor.
Jennifer, any perspectives from your side?
I think what you're saying makes a lot of sense. And around AI, I think it also adds an interesting use case for DeFi, because AI agents are not going to be banked. So I think we will actually see more trading in DeFi once we start seeing AI agents trading.
Can I add one thing? I know that, Bo, this is your expertise in DeFi. I'm not so much into DeFi, we're more CeFi. There's a lot of rumors right now, and I can say there are a lot of goods and bads, and please feel free to add, yeah? The positives in going into DeFi, and we're looking into doing that. Hyperliquid is very liquid. You have a better pricing. You have many advantages in the terms of, you know, when markets collapse, that one still is much more effective than all the CeFi markets. But you have the other risks, which, you know, hacking risk, a little bit more, you know, security risk, counterparty risk. You have to look at it, and it's very hard to convince an investor that he should actually invest into also DeFi and have that exposure.
No, absolutely, and that's why some hedge funds basically have their share classes split. One is for DeFi, and one is for investors who cannot invest in DeFi, because certain investors, when you do not know who is the counterparty to your trade, or where the money is basically being stored, or where it is currently, they cannot invest in those share classes. But I would say also, that we're getting there, but I think that a lot of investors just cannot simply invest in DeFi specifically for that reason. Maybe elaborate a little bit more on be it on a CeFi or DeFi. For the last really 7-8 years, the software vendors have focused on bringing all trades together, meaning that you have one dashboard of all your trades. That is what people very often define. That's my risk tool or risk management tool, just seeing all trades, all exposure. Very rarely do we see actually any analysis that comes with that. VAR, etc., right? Very often it's run separately in different models, and I think that's definitely one thing that came out when I have seen quite a few demos recently of execution systems, of portfolio management systems, is that actually the risk models or modules are not as advanced as you have in TradFi. So there's one thing, again, when it comes to the maturity of the industry, there's still quite far to go.
Ryan, sorry, go ahead.
Yeah, if I could add to that, I agree with that, and that's something that we've actively worked on. So we offer risk controls, we offer RMS, portfolio management, and by we, coinroutes, because, yeah, I think that that's definitely something that's lacking.
Sorry, one more on the DeFi side. So there's different ways how people can get their head around that. So you can purchase insurance. and that's a good way how you can lower certain risks, not all risks, but certain risks. And so clearly there's some sponsors and there's some firms that are great at insurance, specifically for DeFi, when it comes to custody, when it comes to protocols, bugs, hacks. But you need to be very clear in understanding what is insured and what is the cover. Yeah.
Perhaps that's a good segue into looking at the markets right now, the markets since October 10th. Ryan, I know you're not necessarily in the liquid side of things, but perhaps from the sidelines, if it's fair to say that, you correct me if I'm wrong, what are some common sense things you're seeing looking at the space? What are some key learnings you think that have come out of the past few months?
Maybe just before I answer that, just going back to that point about the institutional infrastructure, and we have invested in a company called Hayward, and I think they do the portfolio management piece. But it's interesting because that comes from the pedigree of institutional asset management, and indeed brought in risk capability. So I think as you say, it depends a bit on your lens and your approach. But there are people who I guess get the materiality and the gravity of it. I guess from my perspective, not necessarily commenting specifically on the directional piece of crypto and the recent trends, but I guess what I find interesting is it goes a bit back to my point about how you're starting to see infrastructure which will enable people to start trading it. So, for example, the UK set up the regulatory sandbox, the DSS. The DSS has some new fintechs going through that who are trying to establish essentially digital CSDs. And again, that's a familiar concept that that traditional institutions know and like and understand, and they want to see those institutions there. And as you already hinted, or someone did, around things like perp futures, as that starts to proliferate in the market, that starts to be a very obvious way for institutions to access it. So the banks are much less likely to, I guess the current activity at most banks is going to be those basis trades and those the futures, playing the futures. As you start to introduce the derivatives onto that, that becomes a lot more interesting for the banks, because I guess you need depth and liquidity on that. That's going to enable them to actually start offering a more sophisticated capability to their customers. And then, as we said, there is a whole spectrum of digital assets which will be not just a crypto piece, but if you imagine secondary markets for stable coins, right? If that becomes not so much a trading capability, but a money flow capability, or a tokenized money market fund starts to flip into that, and that becomes something that banks feel that they can route customer money flows into when they're coming in and out of trades. That starts to become a lot more, I guess, interesting as a comprehensive package. And then you won't have that sort of directional, concentrated bet simply on the underlying crypto, if that makes sense.
I'll carry on down the line. Other learnings from October 10th and onwards?
Well, if you ask my traders, they will all say stay away from Binance. The key learning, but not leaving the jokes aside, I think it's very much of improving the infrastructure and going back to the same thing. Don't put all the risk, don't have concentrated risk on one exchange, do your due diligence properly on the exchanges, know exactly what they're doing, what are the reserves, the mechanisms behind stable coins, rewards. This is exactly what happened with Athena. And to be fair enough, Binance published 2 weeks before that, they actually said that they have a problem, they're changing the system. So that's what triggered the whole Athena on October 10th. So the main learning, if I would be to say, it's probably around infrastructures. Make sure that you do a proper due diligence around the exchanges. Don't have concentrated risk. Try to diversify. And going back to my point, we're looking at even hyper liquid right now, a little bit in DeFi, and try to see what backups are there. Don't put all your eggs in one basket.
I'll just add to that from my perspective. Back when I was a rates trader at Nomura for most of my career, all of the hedge funds I was speaking to, the top 10 to 20, a key part was proper counterparty risk management. I mean, it sounds so obvious and dumb almost to say, but it's not done well enough in crypto. Clearly, there's still a lot of work to be done.
Absolutely, because it's very complicated. A lot of things you find them out while you're actually, doing it. And to that point, I've been reading these ratings. This is quite something new. It's called Agio ratings. I don't know if you've seen them. They only rate.
Yeah, I know the guys.
It's very good. They just published the January report, and actually the exchange risk doubled in 1 month. So I don't want to know the report right now. But I mean, it's 12% right now, the default risk, which is quite high for the exchanges, yeah?
But the only thing I was going to add again is, going back to that custody point, obviously, again, from an institutional perspective, the nervousness of just facing exchanges and holding funds on there, that is clearly a concern, which is why, again, when we thought about the infrastructure layer, we've looked at people like Copper in the past around, a clear loop solution, and the idea that you obviously then put that with a custodian, and you're using walled gardens effectively to access market liquidity as and when you need to for the trade, but you're ultimately not leaving capital on exchange.
Yeah, no, it's not about the counterparty risk in the sense of, everything is delegated, but what do you do with your trades if the exchange doesn't work? A case for last weekend, one of the exchanges that we trade, main exchanges, was down for 1 hour. What do you do? In the end, it's not about necessarily, it's about there's no liquidity, it's about you cannot trade, you cannot hedge your positions in kind of disturbing markets like we've seen these days.
Jennifer?
I think I can add to that because, on October 10th, we saw our traders start to really care about redundancy, RMS. So for those who don't know, RMS is reconciliation management, which would show if there's a discrepancy on the exchange versus on the trading system. So let's say you are ADL'd out of a short position. The best move at that time within that 10 to 30 minute short window would have been to pivot and go long. But getting those filled on exchange would have been very challenging. So what our system did was it breaks the order up into a bunch of orders, and then it just executes across all available exchanges.
I'll throw in 2 more because I think there should be a proper session on lessons from the 10th of October. And every year there's 10th of October, but I think there's 2. For allocators, there's 2 things. One is when it comes to the share classes. So some allocators were caught off guard because they did not understand how certain share classes are commingled. So if a fund has dollar, Bitcoin, Ethereum, and some other exotic share classes, what exposures are they taking and how are they actually handling the underlying? Did they sell these exotic tokens and then went long perps, and when there's nothing in the perps, they might get liquidated, right? So there definitely has been some of that, and there's not something that you start thinking about straight away. And second, I think, is on the SMA side. So depending, again, on the strategy that people are running, market making or market taking, there's massive difference when it comes to the performance of the SMAs, who gets executed when, at what fees, at what tiers. So again, from the allocator side, people need to much more question the numbers that we are seeing from the trading teams.
We've got about 7 minutes left, so I think a good place to finish up will probably be around how the space is going to evolve over the next 12 to 24 months or so. We can focus mainly on quant strategies and how we think that will evolve. I know I've got an answer in my head, and it's one word or an abbreviation, so I'm sure this is going to come up. I'll start with you, Bob. We can work back down for the remainder of the time.
Let me split that into these 3 key segments that I track. So the first one is the delta neutral high frequency trading, second will be the DeFi, and third one is the large statistical models. So on the HFT side, this definitely will be even more competitive than it is today. We will see much more trading teams focusing on that when they can pick that up, but clearly the returns are coming down. So what was historically maybe 30%, last year was 15%, I think we will see 10% this year on that front. Clearly you can get some extra leverage somewhere, but when I'm talking, teams that are managing hundreds of millions, that will be kind of the returns, I think. So we're definitely much more competitiveness. On the DeFi side, yeah, I think similar again. The returns are coming down. There's much more sort of new products coming to market. So you will see basically platforms that enable accessing credit funds, like traditional credit funds. I will cautious on that because you need to understand what is the risk that you're underwriting. Are you underwriting a kind of a smart contract risk? Are you underwriting someone's capability or ability to do SME lending in traditional world, right? So that will definitely be a lot of innovation. But I guess these two taken together, that means that a lot of, or many more people are focused on not competing on speed, but competing on the quality of their research models. So the stat arb world, or long, short, and market neutral, depends how you express that trade. But that's where I see much more focus going forward, because the easy money is gone, as I said several times. You need to have good quality research and be able to execute correctly. Not pressing market making, market taking, market making. Know how you make money. Yeah.
I agree with that. I think things are going to get a lot more competitive out there. I think also infrastructure is going to have to be more robust. I think it's not just going to be executing across exchanges, but it's also going to be executing across asset classes. That's something that we saw a lot of interest in, and we've decided to add metals to the system because of that.
Everything that was said here, I agree. I'll just add, I think probably you should look also geopolitically. This year actually, it's going to be a lot about Clarity Act. It's a lot about, all the decisions that, which, how we said, politically are taken lately, which influence a lot. Inflation, Fed interest rates, everything else will add to the environment. It's something that is right now a little bit in limbo. I think it's exactly what you said. Next year, we're looking at a little bit more conservative returns on all fronts. We're looking at a lot of AI. We're looking at a lot of tech and developments in everything that we used to know in the trading space, and more competition. More competition, absolutely.
Yeah, I guess just to add to that, it's going to be interesting to see what big banks do around this, right? So you've had bespoke prime brokerage surfacing in the market. You've had some M&A, some of those, whether it's Ripple have got in on the action. So that starts to bring some scale to the game. I guess it's going to be interesting to see how the large institutions respond, right? Do they start to get comfortable with providing leverage, starting to move and make markets in the space or not? And I guess that's going to depend a little bit on, as you say, the regs and how quickly people establish those capabilities. But they already have a lens over this with the even though they're not trading the underlying. But if you start to see those banks move in, and you start to see the liquidity and the leverage coming off the back of that, then I think you start to see quite a shift in the speed and the approach of the market.
My take is very lazy, and it's the one word I was getting at before, is AI. I know it's such a lazy answer. Something more concrete, I think, that's happening right now, at least at GLASSNODE, is being able to integrate with our data and analytics through an MCP server. I won't bother you with the details. I'm not very good at those details anyway, but essentially it's a way to start asking questions directly to a whole host of different data sources, leveraging AI to do that. It's happening now, but obviously that's only going to keep increasing in the future. Whether it's in the next 12 to 24 months, whether it's in the next 10 years, it's still up for grabs on that front. But let's face it, it's obviously long-term how a lot of the space is moving, especially if we're moving more on-chain generally, and the worlds are colliding in terms of legacy infrastructure, on-chain infrastructure. No one will care anymore whether it's on-chain, off-chain. It's all just plumbing for finance at the end of the day. And how do you best execute? How do you manage risk in the space? Obviously, AI is going to be a key tool. I feel stupid for saying it, but yeah, I had to. So great. I think we'll wrap up there. Thank you, everyone, again, for coming out this morning and sitting here listening to us all talk. And a massive thank you to the panelists for your insights. Much appreciated.
Thank you.
Yeah.
Thank you.